Welcome to the program. And another bank has struck with another double whammy on the interest rate front today. 1 week after the Commonwealth stirred a hornet's nest by raising its variable mortgage rate by almost twice that of the Reserve Bank, the ANZ has raised its key mortgage rate by 39 basis points. Meanwhile, the NAB and Westpac continue to forego millions of dollars a day in lower interest rate revenues, apparently fearful of invoking even greater public and political hostility by following in the footsteps of the other two. Presumably, it's only a matter of time. And also this afternoon, the Australian Securities and Investments Commission released its long-awaited findings on bank exit fees, which act as a disincentive to customers to switch banks in protest against rising rates. Business editor Greg Hoy reports.
The latest assault on big bankers by consumer group Choice.
You know, Morty.
Yes?
They say bank fees are money for nothing. It's not money for nothing. It's money for us.
In the face of widespread ridicule, little wonder big banks appeared to have lost a little of their bravado since Commonwealth Bank was first to heftily hike its variable mortgage rate 1 week ahead of any other bank.
All the banks were indicating to the market and through the media that they would be increasing their rates, and all the banks were indicating that they would be increasing their rates more than what the RBA said. The fact that the others haven't followed suit for 8 days means that they may have been so spooked by the backlash that they're sort of being held out at the moment.
But late this afternoon, the ANZ made its move, lifting its variable rate to roughly match that of the Commonwealth Bank.
We are likely to see the same sort of public hostility to this decision today as we have seen to the decision of the Commonwealth Bank.
Just to kick sand into the eyes of Julia Gillard, the ANZ increased their rates and then made it easier for people to leave the ANZ.
Already over the past week, mortgage brokers and second-tier lenders, including credit unions and building societies, have reported a surge in the number of people inquiring about abandoning the big banks.
Abacus is the industry association for 112 credit unions and building societies across Australia. Since the Commonwealth Bank announcement last Tuesday, we've seen a huge increase in inquiries across our membership and also a huge increase in our home loan applications. People have seen the last interest rate rise as maybe the final straw.
Melbourne businessman Martin Thomas is one of those who's voted with his feet, having exited his mortgage with Westpac and refinanced with the Australian credit union MECU.
I feel like a real person with MECU, and with Westpac, as it turned out, I didn't feel like a person at all.
Come in and experience the thrill of bankers actually caring what you think.
Each of the major banks had sensed the need to improve their image, albeit comfortable in the knowledge that since the GFC, they have grown to control 76% of Australian mortgages.
We were very unhappy about the mergers of some of the smaller banks with the larger banks that occurred during, under the cover of the crisis, really. We don't necessarily, even to today, accept that that was a necessary outcome. And the effects on competition have been obvious. So, we are still very, very keen for the government to push ahead with more reforms.
It's little wonder the Commonwealth Bank moved first to hike rates. The heavyweight champion of home lending, it holds 26% of the Australian mortgage market, valued at $296 billion. Westpac a 24.3% share, or $278 billion in mortgages. Then NAB way behind on $152 billion, and ANZ $149 billion, or just over 26% of the mortgage market between them. All trying to catch up with the Commonwealth, which sets the pace in the banking race.
Remember, we owned the Commonwealth Bank. We, the people, owned the Commonwealth Bank. As soon as we privatised it, it became the object in the artifice of commerce. And commerce has a single goal, and that's to make money, not to provide social services. They provide social services only in as much as it helps them make a profit.
The Commonwealth Bank's chief, Ralph Norris, was not available to discuss such matters. So what still stops people deserting bigger charges by bigger banks to join second-tier lenders, plus building societies and credit unions, who between them share just 24% of mortgage lending? Firstly, hefty exit fees. So ASIC announced measures today to limit such fees to the recovery of a lender's losses. ASIC stipulating lenders cannot use exit fees to discourage a borrower from switching. The ANZ responded that it would either abolish or reduce exit or switching fees. In fact, there's different opinions on what ASIC's action might achieve and whether it has been the big banks who are the worst offenders, or whether that title should be bestowed on some smaller lenders trying to offset their cheaper lending rates.
The banks were never terribly bad at exit fees. It was the second-tier lenders, your GE Moneys and people like that, who were very, very bad at exit fees because they didn't have the deep pockets. Whether ASIC can actually force them to change the way in which they charge for things, I'm not actually sure.
Absolutely, we want to get competitors into the market to compete with the banks, but that's got to be real competition. Their products and services actually do have to be attractive to consumers, and to suggest that the way they can compete is effectively by misleading people into think that their products are cheaper because the fees are back-ended and consumers aren't noticing them. I think that's an outrageous claim.
ASIC did a report back in 2008 and it showed that the exit fees for credit unions and building societies were around about $400 on average, compared to the major banks of about $1,000. So they're certainly lower, and absolutely it also showed that more than half of our credit unions and building societies don't have exit fees at all.
So if it's not exit fees preventing people leaving the big banks, what exactly is it?
The real issue about this is the concept of the single customer identifier, the unique customer identifier, which allows customers to move easily between banks. That doesn't exist at the moment, and there are reasons for that, primarily around the privacy. But the reality is that if that existed, then the ability to move money between the banks would be much, much simpler.
We got an announcement from the government that we were going to make it easier for customers to switch their bank accounts several years ago now, but it was really left to the Industry Payments Association body to develop the package to help customers switch, and it just hasn't really done the business for consumers. It's still very, very hard to use that service. I think we need to accept that it hasn't worked, and we need to move on to things that might actually help people switch their bank account, like making account numbers portable.
So the ANZ has jumped the gun, offering subsidies and discounts in switching costs. But one of the biggest problems stifling competition is not the banks themselves, but the public. Namely, a classic case of good old-fashioned Australian apathy. She'll be right, mate, even if it's costing me more.
What happens in people's minds after the first 1 or 2 years of paying a mortgage, in their minds it becomes effectively a rent. They get used to paying it. And it actually leads to a more sort of, scurrilous problem inside the industry, which is called grandfathering, which is people on loans that they necessarily shouldn't be. They're simply lazy. They get used to paying it as a rent.
If customers just are sticky, they stick with whoever they're with and they don't switch, you actually may as well just have a monopoly provider in the market, because that's the prices that you're going to get offered. We also need to do our job as consumers and actually do the switching where we're unhappy. Otherwise, if we just stick with our current providers anyway, we're not going to drive competition.